Good morning, traders. Today is the 4th of October. My name is Neville Hornsey, market analyst with YouTrading, and today I'm joined by
Joel Frank, also market analyst for YouTrading.
How are you doing?
Yeah, mate, I'm good. I'm excited. We've got a busy week ahead. A lot of things that could go right or wrong, or a bit of volatility. So, yeah. How are you doing?
Yeah, no, definitely all good. So, had a great weekend in London, and happy to be back. So, yeah.
Oh, you were in London. What were you doing in London?
Basically celebrating 10-year anniversary, wedding anniversary.
Oh wow!
And
congrats.
Stayed in an overpriced hotel where inflation's definitely taken hold.
Oh, I know.
A Kit Kat was like £2. It's like
what?
It's just like
what is happening?
A Kit Kat was £2. A can of Coke was £2. There's like some ridiculous prices, but
wow.
But yeah, luckily, the rest of London's not that expensive yet.
No, it's not. Yeah, I mean, my rent has actually got cheaper.
Yeah,
I think it's a bit weird. It's like because there's been that exodus of people out of London because they're working from home more. They want more space. So the renters in my situation, I'm still looking to live, somewhere fairly central and not really looking for a bigger flat at this point. So if you just get in a 1-bedroom flat that's not like massive, it's actually gone down in price for probably the first time in a long time.
Yeah, a long time. Yeah, definitely. All right. So what is happening today? There's a lot of Chinese bank holidays. Is that their golden week, or is that something else?
I think they're actually off for the rest of the week, or maybe they come back on Friday. But yeah, the Chinese market participants are gone now.
Yeah. Evergrande, not a problem anymore then, if they're all on holiday, or is that a problem?
Well, we did have a bit of news flow overnight. Like there were a couple of stories worth talking about with Evergrande. It was like, number one, they were meant to pay a 260 million bond, which, they're probably not going to pay. They've got until the end of
dollars or
in dollars. Yeah, dollars. And I think because it's not the coupon payment, it's the actual maturing bond, which they're meant to pay. So they could default on that by the end of the week, I think. But then also.
With the coupon, they were like having like 30-day graces as well. So I couldn't really work out what the deal was like. But
yeah. I mean, basically, those coupon payments were supposed to be about a week and a half ago, weren't they? But like you say, they get 30-day grace period. But this, because it's the maturing bond, it's like paying back the principal of it.
Yeah.
You don't get the 30-day grace period. I mean, I don't know how it all works with that kind of stuff, but basically there'll be an official default by the end of the week.
Okay.
But the trading in their shares was actually halted. And it looks like a rival Chinese property company could be buying out 51% of their shares. So,
wow.
Yeah. So it's a bit
that's one way of restructuring your debt, just to someone else.
Yeah, yeah, exactly.
All right.
So,
and then, another big one, OPEC meetings all day today.
That's today. Yeah.
Are they going to increase supply? Are they going to readjust the quotas, or are they just going to leave as is?
Well, they're going to stick to the plan that they've already outlined, which is to bring 400,000 barrels per day back online every month now. And obviously they are facing a lot of pressure to do more than that, because obviously oil prices have been rising. They're at like they're close to multi-year highs for like Brent and WTI. A lot of that push higher in oil is because of the natural gas shortage.
Yeah, is that like just dragging up because natural gas definitely fires up a lot of power stations? Are they like able to switch to oil? I haven't worked that one out either. Yeah,
I think I don't know how these power stations work, but I'm sure there's something where they have the ability to switch between fuels, depending on they want to economize their operations. And basically the higher, obviously natural gas is the best. Well, coal's the cheapest, but natural gas is also pretty good. And then I think obviously using oil is probably more expensive. But then when you have a big spike in natural gas and coal prices, because coal's been going up as well, then that makes WTI, obviously natural gas is at like way above, it's like record highs, 4 times more than it was at the start of the year. Oil is gone up, but it's still nowhere near its all-time highs from back last decade. So oil is more attractive for power for utility companies at the moment. So that's
because I read that Germany's going to like ditch all of their coal power now and go with Russian gas and French nuclear. So that is as in energy providers. I just wondered if more of those coal, like European coal power stations, if they were to be decommissioned, there'd obviously be like a bigger demand on like gas and oil, wouldn't it?
Yeah, I mean, the thing is, I don't think they want to move away from coal for green reasons, obviously, because coal's quite. Although in Europe and in the West, we do have the technology to burn coal in a more efficient way than what they do in China and emerging markets.
Yeah.
It is still dirty, way more dirty than gas. So they were trying to move away from coal, and they were trying to move towards renewable energy resources like wind. But the problem is the wind is unreliable. Like this year, I mean, I don't know exactly what it was, but I was hearing something like they were getting 40% less power this year than they were last year from the wind. So then they were like, oh, we need gas. But then I'm not really 100% sure what's going on in China, but China is demanding gas.
Yeah, they've said they're going to secure at any cost, haven't they? They're going to go out and just absolutely gather up all the energy they can.
Yeah.
Right, so you think OPEC themselves are going to stick to the 4,000 extras?
Yes, despite calls for them to up it. So that should contribute to the sort of notion that oil markets are undersupplied. So I think oil markets should be underpinned. And
then obviously, like the UK's in that moment where there's not enough delivery of oil products, but other than everyone's been saying that there's enough oil in the terminals, it's just not enough drivers.
Yeah, I mean, we don't actually have it. Like if you look at, we've got inventories like they do in the US. Yeah, we've got like a strategic reserve, which is absolutely fine. So yeah, it's just the drivers really. That's the worry. Yeah.
So yeah, all right. There's always a weak link somewhere in there. Okay.
Yeah, exactly.
Tomorrow we've got the Rba Rate Statement.
We do.
Obviously, Australian economy is doing really well, bar the lockdowns.
Yeah. Well, I mean, it was.
Yeah, it was like
I know. It's the thing. They've had so for most of the global economy, it was like the big dip was, Q2 last year because of the lockdowns. But Australia never really they had a bit of an outbreak, but they contained it really well. Same with New Zealand. So they never really had a deep recession. They just had a very shallow recession. And then, like you say, for the rest of the time, their economy was pretty strong. But now they've been struggling since the summer, really, with these very strict lockdowns because they've still been trying to follow this zero COVID policy, which I think Delta is more infectious than the previous variants. So their policy of zero COVID just hasn't been working. That they cannot drive it to zero. So yeah, they've been in lockdown. So their economy is doing absolutely terrible at the moment.
So they're not going to be tightening anything, are they, or raising rates? So that's probably going to be the same statement as last time as well.
It'll be so basically the RBA say that the recovery is not derailed, it's just delayed. Yeah. So they're basically expecting this near-term weakness, but then it to rebound next year. But in the meantime, they've paused their QE tapering until at least February, and they're not even thinking about raising rates. Like they're still talking about not raising rates until at least 2024. So they're dovish, basically.
Yeah. Okay. Cool. And then we start getting into things like the US ISM PMIs. We had PMIs last week a bit. How the US economy is not doing so bad, is it? Really? So.
Yeah. I mean. It's actually like the ISM PMIs last week were pretty good. They actually improved, and things like new orders was strong. And there's still these concerns about supply bottlenecks though, and how that's impacting US companies. So that's still a problem. These services PMIs, I mean, the impact of the spread of the Delta variant in the US hasn't actually been as bad as people feared. And so services, hospitality and stuff, probably going to be holding up okay, to be fair. So I think that data should be decent, to be fair.
And then Wednesday's we got New Zealand Rbnz rate statement. Yes. That's probably the same as the RBA as it was the previous month, isn't it? But then,
no, they're gonna hike.
I was going to say that, but they are looking to hike their official cash rate.
Yeah. Yeah, they're going to hike their cash rate because they're pretty much their labour market is at maximum employment, unlike it is in, say, the US, UK, other parts of the world. Their labour market, or they see it as being at maximum employment already. Their inflation's above target. Their economy is, they're actually struggling with a few lockdowns, but it's not anywhere near as bad as Australia. So their economic outlook is very, very strong. They're at the point now where they think if we don't start tightening, because we've got full employment and inflation already high, well, then we're going to start seeing inflation going even more.
Yeah, I was going to say, like, we've got family members coming back from New Zealand because they can't, like, one of them is a New Zealander, but the other one, they're all coming back because they can't get a house. Like, the housing market there has just gone mental.
Yeah, exactly. That's another thing. That's another cause for concern. Like, I can't remember what the number was exactly, but I saw something like in September, house prices were up 25% on the year, which is just ridiculous.
You say that, but like our neighbours sort of switched, like had a turnaround like March, and like the house price that they bought for was just like, oh, whoa, that's expensive for this area. And then March, April, May, June, July, like 6 months later, it's gone like another 20. If New Zealand's gone, like our little bubble down on the south coast has gone 25% as well. It's mental.
Yeah. I mean, in some parts of the UK that are highly desirable for people that, they want to leave London, they want a bit more space.
Yeah.
Maybe they're retiring early. Maybe they're just working in the office 2 days a week. Yeah. I mean, I think the nationwide, I can't remember which housing index it was, but in the UK, that was up like 12% year on year. I mean, that's still a lot.
So yeah, I wonder if that cash rate rise will be as big as they say here. Like it says goes from 0.25% up to 0.5%. So
yeah, I don't think they're going to do a 50% hike. I mean, that would be very hawkish if they did, and in NZD you'd see some serious strength.
All right. Okay. So ADP non-farm employment change. Last week's initial jobless claims obviously rose for the third week. ADP's saying it's going to increase by probably like 90,000 by looks of it. I just think there's going to be the fiscal flows. Obviously, we've got into a new fiscal year now. If we don't sort out the debt ceiling, the Biden's different bills, I can see the fiscal flow sort of starting to drop off from year on year. And corporate sort of forward guidance might start dropping. And obviously the quickest way to like balance that forward guidance is to like start laying people off. So I'm not 100% sure if this ADP is going to be going up for much longer. What say you?
Yeah, it's a tough one. It is a tough one. Like you say, the kind of the fiscal impulse from the government, it is easing off now because those enhanced unemployment benefits are done. The stimulus checks were ages ago now, back in March. The Congress, they're trying to get these new spending bills sorted out by the end of the month. But the thing is, they might not even have that much of a positive fiscal impulse because a lot of it's probably going to be funded through taxation, which that's not creating new money via borrowing. That's just taking money from somewhere in the economy and putting it somewhere else.
And redistribution,
and arguably, this big social spending package is going to be taking money potentially from areas of the economy that are very productive and putting it into areas of the economy that they might be productive in the long term because it will help raise people out of poverty and then give more people opportunities to contribute to the economy over the next 10 years. But in the immediate future, it's probably going to be a drag on the economy. I would think that big social package.
So yeah, if ADP and because we've got non-farm payrolls on Friday as well, which are supposed to be going up, almost 200,000. I guess the Fed need to see that. Jerome Powell said he doesn't need to see a decent NFP to like start this whole tightening, but I think they would rather it did.
You know what it is? Do you know what I think for the Fed now?
Go
on. They've been saying, obviously, their priority is that they're saying, oh, inflation's just transitory. We're going to basically ignore inflation. We really want to get the labor market back to full employment. Obviously, it is quite a political Fed. The Democrats are in power. The Democrats are very much, they care more about full employment than they do about inflation, because they see, they're focused on like social injustice and stuff. And you do see minorities have a higher unemployment rate. So they want to push unemployment down to benefit the minority communities. The Democrats don't really care about inflation. So the Fed, and obviously Powell wants to be renominated. So he's saying what he needs to say. We don't care about inflation. We want low unemployment, to appease the Democrats. But I think the Fed has realized that, oh God, we've messed this up. Inflation is out of control. Look at it. It's like above 5% on CPI.
Yeah, definitely.
So they're going to continue to say, oh, we want full employment before we start hiking rates. But regardless of what happens with the labor market at this point, they are going to do their QE taper, because inflation is just too high and they know it. That's what I think.
Yeah, I just think there's been a lot of talk about whether or not he can get renominated. And I think if he drops the ball in any sort of way, he'll get the blame for the stock market. It's like kind of crashing now, isn't it? So we should probably have a quick look at that.
Yeah, let's have a look at some charts.
US 500 under the 20 and the 50-day moving average, above the 200 still. Corrective, but finding old resistance, now support. So, but yeah, if that was to go down below 4,200, I think Mr. Powell might be sort of seen to be losing control of everything, like you say. And the dollar, I had the dollar peaking in one of these magical chart patterns. And it worked. It worked. So fair play to whoever comes up with that chart pattern. The
thing is, I'm bullish on the dollar. Like, I got to say.
Yeah, you have to be, don't you? It's
just from a fundamental sort of standpoint.
But you got like higher swing highs, higher swing lows. It's just the fact that it just met some resistance. That's all. So whether or not the actual dollar comes down any lower than that's what the support line. I don't know, but that
area which you marked up, where it's kind of reversed a bit back from, like that's a great area to take profits. Like if you've been buying, Dixie in the low 9200s, and you've been aiming for 94.50 or something like that, that's your area to take some profit.
Yeah, definitely. It's also like, I marked up like it's like the flip zone, it. So like support, resistance. But if it was to get back above, it would definitely become, I say definitely, nothing's definite. It could easily become support and then like carry on higher depending on the monetary policy. So that's interesting. But that is given the euro. I always had this double bottom for the euro. It's like sweep back liquidity, go higher. It's obviously in a downtrend, so maybe just a short for that. British pound, I nailed that in terms of analysis like last week. It just,
look at that range that it's been respecting in the last. Oh, this is on 15 minutes. Oh, okay.
So it's just 15 minutes. I saw like a bottoming pattern, like with RSI, stochastics, and MACD and stuff, and said, well, if it was to go higher, it would start stair stepping. And if it stair steps, then it is definitely quite bullish. And that's what it's doing now. So if this starts going up like towards the 140s again, then it's going to go up, sideways. So that's something to look at.
I mean, the thing with GBP is it got hit pretty hard last week, didn't it?
It looks good. Big sell-off, I mean, even on the 4 hourly, it looks big,
arguably that move is a bit overdone, you could say, because like obviously the BOE has been quite hawkish recently. We've seen UK bond yields rising. So, it looks like GBP got quite cheap, you could say, by the middle of last week. So, I mean, for some people looking to just sort of trade like FX value, like fair value kind of trades, that could be helping GBP at the moment.
Yeah, and I guess to anyone that is bullish at the moment, it's coming into some resistance, and the sentiment on the retail is getting quite high. So it's bound to like find this area quite sticky to get through, and probably pull back. But the other one was like Brent. I just had like a bit of resistance becomes support. It definitely became support, and off she goes. That's and we said that doesn't look like it's coming down for a while.
I can't see it at the moment.
So
in the lot for crude oil, I think there are some potential things that could weaken it, but so things like you're slowing growth in China, the potential for a bit more of a slowdown in other parts of the world. But at the moment, we're more focused on like the energy shortage. So I think for the time being, bullish.
So if oil's going up, then you would expect the Canadian dollar to go up and the US dollar to maybe weaken slightly. But a weaker dollar obviously pushes the oil price up higher quicker, doesn't it? So it'd be interesting to see if the dollar CAD can sort of confirm whether or not the dollar is going to weaken or confirm that the oil is getting more expensive. Because, that's one way of doing it.
The problem is the dollar's been doing well recently, which makes it tough for dollar CAD to continue to depreciate. But I think it can still head lower as long as oil prices have a positive bias. And we got Canadian data as well on Friday, labour market data to go alongside the US data. As long as in the near term, as long as that's not awful, as long as we can expect the BOC to continue to be a little bit more hawkish than the Fed, should probably still have a downside bias.
Yeah. And like the sort of safe haven type of trades that was on the back of enhanced risk from China and stuff, that seems to have dissipated now. Like gold's going nowhere again. I thought there's going to be like a bit of a bullish reaction. Silver looked like it was going to have a bullish reaction off like some of these lows, but that looks like it's short-lived. It hasn't like just powered through. The long bond, like 20-year bond, that obviously came down, but I would have thought it would have gone up. Obviously that was not the sort of safe haven sort of trade to go to when the world was crashing. Normally you see like stocks go down and bonds go up, but
I know.
They move together.
The reason why I think it wasn't is the safe haven that was sort of chosen in the last week or 2 weeks. The main safe haven was the dollar, because you had inflation fears rising in the last couple of days because of this whole energy thing we've been talking about. Well, bonds are, when inflation goes up, that devalues bonds. And also you've got the Fed being more hawkish. That was just over about a week and a half ago now, wasn't it? Yeah. And obviously higher interest rates from the Fed, that pushes yields higher as well, which pushes bond prices down. So it's been enough for them to be a haven recently, which may remain the case.
So if bonds were to recover, I don't expect then probably the equities to come down a bit more. That's what I would think, because we've kind of gone through all of those sort of, it's everything that you just said has been priced in now, hopefully.
Yeah.
But all right. So that's kind of like all the majors. Anything else you want to say?
Yeah. I think we've talked about the calendar, haven't we? Is there anything we missed? Just take a look. Yeah, I think we pretty much covered everything. Cool. Bit of central bank speak from some of the major central banks. Keep an eye out this week as well.
The last couple of weeks with those guys has just been so annoying. God. I think we need to like compress it into like 1 week and just say, look, if you've got something to say it now, because just when they drag it on and on and on with speeches everywhere.
They do love chirps in, don't they? These central bankers.
All right, cool. I'll catch you next week for definite, and have a great week this week.
You as well. Speak soon.